All right, clearly a day of positive territory for the markets, but the markets have cooled off from the day's high levels, and contributing to some of the weakness for the markets in the last couple of minutes have been the financial companies. The financial stocks have weighed in into the market's performance, and apart from that, from the broad end of the markets, you can see that the mid caps have fizzled some bit of a rally, and it's settled with about nearly flat with a negative bias. But yes, apart from that, consumer durable index, some of those stocks also came under significant pressure. And you can see that Nifty closed below that 24,150 mark, so to say. Now, let's quickly move on to talk more about markets, Q for earnings season, and of course, what the oil price swings mean for the markets going ahead. We have market expert Sunil Subramaniam joining us to understand what all of this means. Sunil, sir, good afternoon, and so good to have you back. But, the markets, they have been quite in a flux. There's no resolution yet in terms of the war, and the blockade continues and the oil price swings continue. So currently, how are you reading the mood?
I think that essentially this is a time when I think the DIIs are probably driving the market in terms of their sector and stock picks, because I think FIIs would still be relatively soft. Obviously the data will come today, but if you look at the kind of movement in oil prices, after the UAE exit was announced, there was no softening. From 111, it's moved up to 115. The rupee is also weakened. It's close to now 95, 94, 85 when I last saw it. So definitely from an FII perspective, they are not good stuff as far as India is concerned. So I suspect that today's rally was more of mutual funds looking at the earnings season and deploying, and retail stepping in strongly. That's why the broader in the market, I think, held up. But like you said, towards the end, see, one of the things which I noticed, I'm not a technical person, but I noticed that there was a huge amount of shorts which was carried by the FIIs yesterday, and because of the expiry and then the May season session starting. So I think a lot of the move today could be by short-term moves, both from FIIs and retail, in terms of trading into stocks, maybe some short covering somewhere, something. So to that extent, I would say today's market is not really reflective of the reality of the situation. If oil has worsened, rupee has worsened, and we don't have any signs of end to the geopolitical stalemate in the Gulf, I think that it's essentially domestic mutual funds doing sector rotations, which has taken the market to some ways. Second is FIs would also have been nervous or hesitant in pause mode today because of the Fed rate decision later tonight. So they'd rather wait for clarity around that before they commit. So like I said, I suspect when the data comes out in the evening today, that today is more been domestic participants' thought processes in terms of sector rotation. That's why you saw a rally at some point and then a profit booking at some point. And I suspect that will continue to be, even tomorrow, depends on how the rate hike decision comes through from Fed, will continue in this way for some time. So earnings season, it's too early to really make sector calls. I feel that when the markets tended to react, when one company is reported very good earnings, then immediately the whole sector has tended to rally, but without the earnings of the rest of the companies yet coming through. So I would say that the market is in that kind of a situation where, people are rushing in to buy before it's too late because they feel that a significant amount of correction has happened. But then as the earnings pans out, they will need to revise their pick. Some of them may turn out to be right, but some of them may not. So it's going to be a sideways moving market till bulk of the earnings season is done and we get more clarity around the geopolitical situation.
Okay, got it. So, sir, what are you watching out from tonight's Fed meeting? Of course, it could be the last one, before the Fed Chair Jerome Powell's, the last meeting. So, any factors that you're watching in? Because currently the markets are pricing in about, that there would be no, it will be a status quo policy.
Obviously, the markets will think it's a status quo policy because I don't think there's enough evidence for Fed to act anyway. If you look at the inflation has been rising, but there's case that it's war related and the war is not a permanent situation. It's not a fundamental alteration of the American economy's demand and supply situation. So when the war goes away, that should slip back. So to that extent, but I don't think that Mr. Powell, given his already stated stance, will see that as a short-term spike and hence push ahead with the rate cut. There's no way that he's going to do it in the last bit of his policy. The dot plot that the Fed governor they come up with is key to watch in terms of what they are tracking and one. As of now, I don't think that really there's a case for a rate cut for the rest of this year. though Mr. Walsh, the new Fed pick, would like to help Mr. Trump out with a rate cut, because Mr. Trump has been crying himself hoarse for a rate cut, right? And too late Powell is what he's been talking about, Mr. Powell itself. So there is pressure on Mr. Walsh to consider a rate cut. But today, Mr. Powell, what he feels about the future doesn't matter, because he's a lame duck in that sense. So, but overall, the set of Fed governors, what do they read? How are they voted? What are the trigger points they are tracking? I think those will be interesting to know whether we rule out a rate cut for the rest of the year, or do we still factor in one or two? So I think it's a forward direction of the Fed policy, which the market is waiting to see, not what the policy decision itself is.
Okay, got it. Sunil sir, let's get in your take for the oil prices, given that UAE, they have announced their exit from the OPEC and OPEC Plus alliance from May 1st onwards. So how do you read the situation, and do you see any impact in oil prices? Because given in the fact, in the past we have seen that UAE, they have been an advocate of increasing the oil production. But now with them exiting, how do you see the supply dynamics going ahead?
No. In the contrary, I think their exit helps them to increase production at will. Because you see, two things have happened. One is that they have been given a limit of 3.4 million barrels per day, and they have clearly got more capacity than that. So they've been unhappy, and they in fact have been producing 3.6 million barrels, slightly over what OPEC has allowed them. That's number one. Number two point is that they've just invested over the last few years $150 billion in expanding capacity for the Abu Dhabi National Oil Company. So by already they have about 4.8 million barrels per day capacity. By next year it should be touching 5 billion. So when you see that they have such a huge gap, and because of the war, they have been forced to cut further their production. So from a limit of 3.4, they've actually been selling only 2.7. So you can see that when the war gets over is when they will be able to step up to double the capacity of them in a free. There will be a free swing trader, because they're not bound by the OPEC rules or anything. So they will add to the supply situation. So the issue is that why the oil prices not reacted, in fact reacted negatively, is because of the fact that all of UAE's oil goes through the Hormuz Strait. So if there's no supply increase possible till the Hormuz situation is resolved. So there's no immediate impact on the oil scenario. But from a perspective of why the UAE did it, there are three reasons there. One is politically, they have not been aligned with Saudi. They've been unhappy with them. They're being treated in the OPEC with kind of not allowing them to have a larger share, because they're the third largest producer within the core OPEC here. Second is on the war itself, that they have a very different view to Saudi. Saudi wants to make peace and kind of patch up with Iran and keep things going, whereas UAE is clearly wanting to be more aggressive and firm and is on the side of the US. So to that extent, the US will also want them to pump oil. So at the right time, UAE supply will come in and aid. And then when you look at it from a medium-term perspective, right? Give me 2 more minutes to finish this answer. Medium-term perspective, this 5 million barrels, because UAE is already 4% of the world's production. Now, if they are going to double this up, right, you're going to be a significant player, and they are friends with India, so India should be able to get a supply from them easily if need be. But more importantly, there's going to be a lot of demand destruction because of the prolonged war. Airline industry, petrochemical industries, all of these. So if you see that situation, and as soon as the war gets over, all these economies will be pumping oil as fast as possible. There have been some damage to gas infrastructure, so that will take time to come up. But why I'm saying this is, if you look at then the projection of 18 months down the road, prior to this UAE exit, there was an expectation that oil would roll back, let's say, to $80 or $85 only, and that it wouldn't be able to go further lower. But now with UAE supply coming in, because when UAE then supplies, Saudi in its retaliation would probably increase their production so that UAE doesn't get a too big a price on its oil. So it's going to be a nice game of snakes and ladders there. And as a result of that supply exceeding demand, now I actually feel that in 18 to 24 months, oil could retrace back to $65 to $70. Now, if you're looking at it in a medium term, $65 to $70, that's the best news for only one country in this world, and that's India. Because we are the country who imports 85% of our oil. So if in our future we are seeing a time when this whole thing was just a short-term spike, and it will help our fiscal, inflation, a whole host of companies which use oil. So medium term, this actually represents an excellent opportunity to take a medium call on India, It doesn't need to be with oil because the whole economic situation, the fiscal situation will improve if you are going to have oil at $65 to $70. So the UAE move is a short term no reaction, but a medium term definitely favorable for a reduction in oil prices, which I think from our economy's perspective is a welcome thing.
Okay, got it. So we're just waiting for the Strait of Hormuz blockade to get lifted in, and then the things might get settled from there on. Okay, got it. Sunil sir, let's talk about earnings now. I mean, what's your first assessment of how corporates have been delivering their March quarter performance? Do you think, they are better than expected, or would you have to revise your FY27 expectations? What's it like?
It's better than expected, but we'll need to revise our FY27 expectations. Both are true. They might seem contradictory. Why I'm saying this is because the war started on 28th February, market itself knew there's going to be a one whole month of oil-related impact on all the companies' numbers. So the analysts who look at it already factored that in. So those expectations were lowered, and to those lowered expectations, the results have been positive. But however, on a QOQ basis or a YOY compared to last quarter to this quarter basis, definitely there is pressure there, and hence we will need to revise the FY27 EPS guidance down. So earlier I remember it was about 14% for large caps and about 18 odd for mid caps and about 20% plus for the small and micro caps was what was being factored into our forward PE. That will need to be revised down because the war impact is not just March now, it's well into April. War may well be into May and June. So you're going to see a prolonged impact, and mind you, the inflation numbers are still not reflecting it because government has not passed on the price increase. But our oil basket price has gone up from $70 to $110. That's a 60% increase in the cost. So somewhere the economy will need to feel the heat, whether it's the government through fiscal deficit, whether it's corporates through their margins being pressurized, or it's the retailers who are getting hit by higher petrol and diesel prices and other petro input related commodities like paints and tires all going up, their consumer surplus is going down. So there is going to be definitely impact of the war. Today you are not able to quantify it properly because the government has not allowed the pass through completely to the retail person. So once day after tomorrow, the last polling, or today was the last polling. So who knows, anytime now there could be a decision around petrol price hikes or a petrol cess being put on income taxpayers. So there are a lot of uncertainty around this. And to think that, like an ostrich puts his head in the sand and say, oh, the war gets over, but it will not be affected. No, there is damage being done to the Indian economy as we speak, to corporates as we speak. But that means that the forward revision for both the GDP and the fiscal deficit and the EPS growth all will need to be revised by towards the end of the earnings season. So to that extent, yes, I think what forward PE is the market's current correction and state, reflecting that adequately, or is there some further correction needed, or the opposite way, if the market has overreacted? We'll get to know only when the earnings season has passed. Right now, like I said, for me, the positive has been, I think by and large, the banks have been happy because the NPA levels have been stable, the credit growth has been strong. Yes, there is a fight for deposits, but when credit growth is strong, they should be able to pass on the higher deposit cost to the borrowers. And the borrowing also, I'm happy to see that it's coming from rural recovery, it's coming from consumer sector, auto sector, for example, sales have been good. So because of which banks, EMIs, the credit growth is good. So overall, the banking space have been happy. Even on the asset management on that side, I've been reasonably happy with the results. FMCG has been okay, though some of the results have been good. But the rural recovery seems to be more on the consumer durable side than on a mass, and we have to wait for the monsoon. That's another if factor this year because I think last I saw was 92% of long-term average. So we'll see how that pans out. So there's still a lot of uncertainties, but hopefully by the end of the earnings season, right, we should have clarity around a lot of these factors. And first quarter GDP numbers should be coming out by, say, mid-August. So I think we have to definitely be prepared for some impact of all of these. And it's too early to say whether the markets are still reasonably priced or not, because we don't have a definitive FY27 EPS estimate locked down yet. So we'll wait and watch for that scenario. Consumer discretionary also, I feel, will end on a good wicket because the summer has been a very hot summer. So hopefully air conditioners and refrigerators, those sales should come and those numbers should provide some cushion to the market. So to summarize it, I think what so far my takeaway is good credit growth, good rural recovery, and a good consumer related expectation in terms of growth. The rest of the numbers, I'd rather wait for a little more companies. Just one company, and the market has tended to react very strongly to just one leader company's earnings and reflect the whole sector. I don't think that's going to be true. We'll have to wait for a bunch of companies in every sector to do it to get a proper feel for a sectoral outlook.
Okay, would that stand same for the platform companies as well? I mean, we did see a good guidance which came in for Eternal, but they are saying that they are not seeing any serious impact of the LPG crisis in Q1. I mean, how are you placed there? How do you think they look like?
See, the LPG crisis, you're not seeing an impact, but I think you and I, if you go to a restaurant, we know that half the items on the menu are off the table, right? So I think that what's happening is that people are realizing that they're ordering what is available. So when they say they're not feeling it, but you can feel it, right? When you go in there, when I go to a restaurant, he says, sorry, sir, because of the gas crisis, only these items I will provide. So tandoor items have been given because they are just a big slow cooking, clay oven, not a gas. So I think that definitely the impact will be felt, but the government's decision to not increase petrol and diesel prices and absorb the excise duty has been a big thing in favor of consumer sentiment not getting affected. So, like I said, we'll wait for the next couple of days to see whether the government is indeed going to do. Though the noises from the government are that we're not planning to do. But God knows how the arithmetic is going to work out, right? The numbers are stark in terms of the cost increase of imported crude, and who's going to pick that can up? That's the $1 million question. And while you mentioned that the platform companies are showing good numbers, people's consumer sentiment is fairly strong, right? Right now, they have not felt the heat of the war really. There were rumors of petrol and there were lines when the war started, but today the petrol situation is fine, diesel situation is fine. Nobody has really felt the heat of the war yet. So to that extent, the outlook is positive. But like I said, I'm a bit on the cautious side in terms of really assessing the impact of the war when it really plays through into the economy, right? Which is not yet done. So I would hold my horses in terms of reacting to results at this early stage. Maybe when 3/4 of the earnings season is done, I'll be able to do a better assessment. Right now, it's too early days to make an assessment of a broader thing.
Okay, got it. Sunil sir, we have seen a good recovery from the broader end of the market since the March lows. But from a valuation perspective, how comfortable are you seeing this rally?
So I think that from a broader end perspective, those valuation numbers still look pretty rich. If you purely go by the PEs, the only thing says why they look justified is that the buyers in that space, let's say, are predominantly mutual funds, right? And so what happens with the mutual funds is when we look at the PE ratios that are available, either you have a trailing PE or you have a 1 year forward PE. But typically, two things happen. When a mutual fund looks at it, he's got a 3 to 5 year outlook. So what he does, he takes the cash flows of the company for a 3 to 5 year and then discounts them. So on that scenario, for them, the valuation may look reasonable because you're compounding the growth at a high double digit for these companies. For 1 year, that's not adequate enough to justify, but you take a 3-5 year, it looks reasonable. That's number one. Number two fact is that a lot of these companies are highly operating and financially leveraged. So for them, scale is important. So the thing is that a 10% rise in their sales can lead to a 20-25% margin expansion and bottom line increase because of their high fixed cost, right, in the mid and small cap. So the point is that though their sales growth may be going at 10 or 12%, the profit growth could be much higher. So when you then do a forward calculation, right, fund managers stroke analysts will factor in the higher earnings growth and not just what is for the 1 year and then taking that for the next year. They could be actually doing a V-shaped. So I would put a lot of confidence behind the fund managers picking these stocks and say that for them, they represent a reasonable value zone, though from a market 1 year forward PE, they're still trading in the high late 20s, early 30s, and they look to be overvalued. So I'm of the view that the growth in the future would come and justify these valuations. So from that perspective, while they are not cheap, if you're buying good growth companies, right, and you're done your due diligence to have a solid reason for the growth to justify I think they're worth it to buy, and that's what has been happening since the crisis itself started, or the last few months.
Okay, got it, got it. From a sector perspective, we've seen that, PSU banks before the war had started, they had seen a good rally. But right now you can see that majority of these names have been trading quite sideways since the war has, started to emerge. And yesterday we did see ECL guidelines which came out by RBI, which also got them under pressure. Today also Nifty PSU banking index saw a little bit of a pressure. I mean, what's the way ahead for the near term and the medium term outlook? What's your thinking?
I'm a contrarian here. I am very bullish on and I think the ECL framework is a big positive from an investor's perspective into the banks. So let me explain myself here, right? So if you look at the PSU banks, the reason for the rally we all know, right? There was a huge discount on price to book between the private sector banks. They were having a large CASA balance access, which helped them a lot of cushion, and the pressure on the banks started before the ECL guidelines, partly because when the G-Secs price went up, right, there was fear of the mark-to-market impact on their treasury income. So that was one thing which took some steam off the table. The second reason that they corrected is also as the lead up to the earnings season, the DMFs who had bought the PSU banks for the last year and a half made plenty good money of them, wanted to book profits because you need to keep your gunpowder or whatever firepower ready to pick the sectors. And mind you, last month, the DIS actually put in 1.5 lakh crore into the market to fight the FII pullout. So they also drained their cash balances quite a lot in the defense. So now, to be ready for the earnings season, they have to book profits, and the PSU, being the best performing index over the last 2-3 years, was this ideal place for them to book their profits and use that. So that's another reason for the pressure. Now the ECL guidelines itself, yes, they were there sometime in coming. To some extent, the fund managers that I speak to and all were aware that they're coming. They were not negatively surprised. But yes, there will be a capital adequacy impact is what the market fears. But remember two things here. One is that who's the owner? If you need to put in fresh capital and shore up them, who's the owner? It's the government of India. Now, are you doubting that the government of India will put in the necessary capital? I don't think anybody doubts it. Number two, what is happening is that they have been one of the heavy dividend payers to the government of India. So all they need to do to restore their capital adequacy, if the ECL norms means they have to provide more, is to reduce the dividend they pay back to the government of India. So instead of government putting fresh capital, all they do is take less dividend. So the capital adequacy situation will get easily addressed. That's one. Second is that now these guidelines, what do? They make the banks cleaner and less riskier from an investor. So when you look at it from an FII perspective, for him, right, these norms actually make sure that the bank's NPA books and everything are going to be much more, on the dot, reacting to the situation, providing well before the bad news comes, and they will be very happy with this. So I see that they will view this as a positive, and when their tide towards India turns less negative, right, these will be among the banks they will pick because of these guidelines, because risk is a very important part of this. So, and then one more thing is that I believe that these norms are also part of a more medium-term process that the government has started, and I expect this to happen maybe by the end of this financial year, is a merger of the PSU banks. See, this time around, the merger is going to be about merging good quality banks with each other so that they get scaled up to international size and they can tap capital. Because as you know, they've been challenged in terms of raising deposits from public, the cost of deposits going up, whereas they can tap, for them to tap international capital, whether it's through dollar loans or through masala bonds, which are rupee loans borrowed outside India, they need to be of a certain size and of a good risk. So doing these ECL norms, getting their balance sheets properly, and then doing a merger. And unlike old mergers, which were bad banks with good banks, right? Trying to pull up the bad banks by getting a good bank. These are going to be good banks with good banks, reasonably good banks with reasonably, so that they get scaled up. And with the new ECL norms, they are much more better with capital adequacy, so they can raise foreign debt. So that's a huge positive for the PSU bank, because then you will immediately come into the radar of the FIIs. And when then the Nifty Bank Index gets rejigged, right, a lot more PSUs will form a part of the Nifty Bank Index, and hence they will get access even to passive money coming into India. So for me, in the short term, yes, because they may not participate in this consumer lending, which this summer will help the private sector banks. PSU banks are not the greatest in terms of smart turnaround at the consumer for a vehicle loan or a EMI based fridge purchase or whatever, right? So they're not going to really. But when the capex cycle picks up, right? They are the ones who are going to lend to SMEs and MSMEs because they have a super hold on that segment where the private sector NBFCs are still finding their feet on how to lend to that segment. So their loan growth in that scenario, which is less rate sensitive, mind you, because they're not lending to the AAA corporate, they're lending to MSME and SME. So they will be able to get a very good interest rate spread and the NIMs will widen that. So given all of these factors, I believe that in medium term, these corrections happening in the PSU banks are a very good spot for a long-term acquisition and hang in through the period in the near term when there could be pressure, which is again, let me repeat, profit booking because they have been the most rallied stocks. Second, this apprehension around the ECL guidance. And third, like I said, the market share in this immediate months may be favoring more of private sector banks in lending to the personal and the consumer segment as opposed to industrial, which will come in later. So to me, they are a good medium-term buy.
Okay, good medium-term buy. And of course, you're seeing some good passive money also coming in after the tightening of the bad loans framework. All right, good conversation, so like always, appreciate our time and thank you so much for joining us.
Thanks a lot.